Picture this. A single ounce of uranium holds the energy equivalent to 20 railcars full of coal, enough to power a city block for a year. Yet for 15 years, this miracle fuel languished in obscurity. Mines mothballed, investors asleep at the wheel. Welcome to the uranium bull market of 2026, where supply craters meet insatiable demand from AI data centers, net zero mandates, and energy-hungry nations. I'm breaking it all down today. The catastrophic underinvestment, yawning deficits projected for decades, explosive demand drivers, historical cycles that scream buy now, and precise ways to gain exposure without getting burned. If commodities are your game, hit play, grab a notebook. This 20-minute masterclass will arm you with the conviction to act. And stick around to the end for my cycle-positioned picks that could 10x. Let's ignite. Uranium wasn't always the villain. Discovered in 1789, it powered the first nuclear sub in 1954 and lit homes via reactors by the 1960s. But 3 Mile Island in 1979 and Chernobyl in 1986 flipped the script. Panic orders canceled, prices tanked 80%. Then Fukushima in 2011, spot prices plunged from $73 a pound to $18 by 2016, a 75% wipeout. Germany idled all reactors, Japan slashed 40 plants. Producers capitulated. Canada's Cigar Lake flooded twice, halting output. Australia's Ranger closed after 40 years with $1 billion cleanup. Niger's Cominac and Arlit mines shuttered amid jihadist threats and debt. By 2018, global production hit a 30-year low of 54,000 tons, down from 70,000 pre-Fukushima. Exploration? Devastated. Annual budgets cratered 80% from $250 million in the 2006 peak to $50 million by 2020. No major discoveries since 2010. It takes 15 years minimum to greenlight a mine. Permitting, feasibility, construction. Result? A supply cliff. Kazakhstan's Kazatomprom grabbed 43% market share with cheap ISR leaching, but even they underdelivered 17% in 2024 due to sulfuric acid shortages. This neglect engineered today's perfect storm. Fast forward to 2026, primary mine supply covers just 78% of demand, a 6 to 10 million pound annual shortfall today, exploding to 45 million by 2030 and 197 million cumulative by 2040. That's 11 new Cigar Lakes, impossible short-term. Kazakhstan holds the chokehold with 23,000 tons output, but 2026 windfall taxes and floods cap growth at 3%. ISR limits scalability. They missed targets repeatedly. Western restarts lag. U.S. bans Russian uranium, effective 2024 to 2040, voids 20% of supply. Paladin's Langer-Heinrich restarts Q1 2026 at 3,000 tons but ramps slowly. Canada idles MacArthur River for maintenance. Secondary supplies vanish. U.S. DOE auctions end. Russian re-enrichment stocks depleted by 2028. Utilities hold less than 18 months inventory, record lows. Geopolitics bites. Niger coups halt Orano. Mali instability. Namibia royalties spike. Spot prices? $82 per pound in January 2026, up 30% year-to-date. Long-term, $105 locked. Analysts forecast $120 by mid-year, $135 plus if deficits hit projections. No quick fix. New mines cost $400 million plus and 10 years. This is structural, not cyclical. Nuclear isn't dying, it's exploding. World Nuclear Association projects reactor capacity from 398 gigawatts electric today to 746 gigawatts by 2040, an 88% jump, requiring 150,000 tons uranium yearly versus 62,000 now. Demand jumps 28% to 87,000 tons by 2030. China's frenzy leads with 27 reactors building, 40 planned, needs 20,000 tons per year by 2035, stockpiling aggressively. The West awakens. U.S. adds 5 gigawatts by 2030, with Trump's $2.7 billion reserve buying 40 million pounds. UK small modular reactors, France extends fleet. 71 gigawatts under construction globally. AI and tech boom. Data centers guzzle 10% US power by 2030. Microsoft, Google contract nuclear direct, Vogel-style PPAs. One hyperscale center equals a reactor's output. Net zero math, nuclear at 10 grams CO2 per kilowatt hour versus solar's intermittency. COP goals mandate tripling capacity by 2050. Utilities scramble. Contracting volumes hit records, but only 72% needs secured long-term. China alone uncovered 15,000 tons. Baseload king uranium wins. Uranium cycles mirror oil. Booms like the 1970s at $40 a pound, busts in the 1980s at $15. Repeats. 2007 peak hit $138 on reactor builds. 2011 crash echoed OPEC floods. But today is different. No overbuild, pure fundamentals. Post-Fukushima lost decade mirrors the 1980s gold drought, then 10x gains. We're mid-acceleration. 2021 to 2023 bottomed at $25, now leg 2 like 2003 to 2007. Catalysts ahead? U.S. Section 232 tariffs, restart waves 2026 to 2028. Risks? Kazakh surges or recession dips, but deficits persist. History says hold through volatility for 5 to 10x returns. We're mid-bull with prices at $80 plus and miners lagging, so prioritize producers and developers diversified wisely to avoid pure explorers, which is still too early. Start with ETFs for safe entry, like Global X Uranium ETF or URA, with $3.8 billion in assets under management and 25% weighted to Cameco, delivering broad exposure to miners and utilities with 150% gains in the prior bull leg. Or Sprott Uranium Miners ETF or URNM for pure miners and juniors beta, with higher upside potential but watch liquidity. For Tier 1 producers, go with Cameco or CCJ, the $25 billion cap giant running McLean Lake online, with contracts locked above $60, though watch execution delays. Or Kazatomprom via depository receipts, controlling 43% of supply with solid dividends, but exposed to government taxes. U.S. ISR growth shines in Uranium Energy or UEC, a $2.8 billion play, restarting 4 projects in 2026 with 100% uncommitted pounds, offering 5 to 8x leverage pending permitting. High-impact developers pack the biggest punch, like NextGen or NXE, with the Rook 1 project poised for £30 million per year by 2029 and true multi-bagger potential if financed. Or Denison Mines or DNN, advancing Wheeler River ISR at the lowest costs, though still in studies phase. Allocate to ETFs for ballast, to producers for cash flow hedges, and to developers for torque as prices push past $100. Rebalance quarterly, favor long positions over options early, and track spot prices via UCX for conviction. 2026 game changers loom. Langer Heinrich and Ranger restarts falter, AI contracts spike, Trump DOE buys accelerate. By 2040, a £1.3 billion gap points to $150 plus prices as probable. This isn't speculation, it's arithmetic. You've got the full thesis, conviction forged. Subscribe for more weekly deep dives. Drop your top pick below. What's your allocation? Like, share, join the uranium revolution. Power on.